During this coronavirus recession, are you getting what you should from your advisor? Do you even know how much you're paying them? In this video, I will share with you how to assess whether or not you are with the right advisor and what the costs are. Hi, my name is Mark Singer, founder of the Retirement Authority, and for timely and up-to-date information on retirement and income planning, click on the link below to subscribe to our channel and hit the notifications bell so you're alerted to when we post new videos. Studies have shown that advisors don't do very well during crisis. What do I mean by that? Does it mean their investment portfolios don't do well? No. It's more about how they behave and how they interact with their clients during some of the most crucial times that we've been through. Studies came out after 9/11 and after the Great Recession of 2008, indicating that many advisors were not proactively reaching out to their clients to see how they were, not just financially, but health-wise. Some didn't even answer the phone calls. A lot of that happened during and around the time of 9/11. So I want to talk with you about what to expect from your financial advisor during this time of crisis. First question you need to be aware of, and you need to understand the interaction. What are your expectations for your financial advisor? There's no right or wrong here, okay? You may want somebody to hold your hand all the way through. We certainly do that with our clients, but that's not for everyone. Some may want somebody who's just there and they'll call them, okay? Fidelity, a TD Ameritrade, any of these places where you can give them the money, you've got somebody to call, hopefully a qualified person to call, when you need to make something happen, but that's not being proactive from a financial planning perspective. Do you want that or do you need that? Again, no right or wrong answer. What are the communications during this time? I know that we are actively pushing out all sorts of communications, not just on investments, but how to really survive and maintain our sanity through this time that we're all dealing with. But you may not need that. Passive investing may be fine as well. Does the advisor call you during these times? Again, I know we have very rewarding conversations with our clients during times like this, just talking about what's happening with the family, how are they doing, how are they maintaining. It's tough for those of us who have grandkids. We can't touch them. We may see them on Skype or FaceTime, but we really get to hear what's making them tick, what's keeping them up at night. Do you need that? You may not. So there isn't one right advisor or model for everyone. So you need to decide what your expectations are from the advisor and whether or not you're with the right one. And if you wait to the end of this video, I'm going to share with you a very costly mistake I just heard about from somebody who was just referred to us. I want to share that with you. The second big mistake, and I've been in this business for over 30 years, so I've heard this question a lot. You're asking the wrong question. The question you typically come in asking is, what do you charge? So some may charge a planning fee. Some may charge what they call an assets fee. They charge you a percentage of the amount of money that you bring into them to invest. Some may make a commission off of that, though that business model is dwindling. So most of the advisors you'll talk with who you're looking to engage for a long-term relationship either do one or both. We do both. The planning, we charge a fee for the planning, and then we charge a fee for the assets. But that's not the question you should be asking, because it doesn't give you an apples-to-apples comparison. The real question is, particularly with your investments, not what do you charge, financial advisor, but what's the total charge? Because not only do I charge something, and we will, because we're not a nonprofit and no financial planning firm is, there will be a fee for the value that we offer. But there's also usually a charge on the underlying investments. So when you are trying to assess the cost of working with an advisor, don't ask them just what do they charge. Ask them what the total charges are. It's a more comprehensive answer, and there's much more disclosure, which I think is the proper way to go about interviewing and assessing whether you're with the right financial advisor. The third mistake is not understanding some of the hidden charges. I believe in full disclosure. I think it's very important in our industry. You should always keep the client first, and therefore, disclose to them what is going on, even if they're not asking the question. And one of the questions you're not asking is, with regards to usually the mutual funds that you're in, what the turnover ratio is. Now, if it's in an IRA, it doesn't matter, because the turnover ratio is, sort of think of it like in a retail store. There's a sweater on the shelf. When you buy the sweater, the retailer has to put in another sweater to put in that place to sell to the next customer. For the mutual fund, they have stocks or bonds that they buy or sell, and the more they buy or sell, the more transactions there are. There could be transaction costs associated with that turning over of the fund. And if it's a taxable account, there could be a much higher rate of taxes. It is a very poor efficiency relative to most mutual funds when it comes to taxes. You don't have control over when you buy and sell, because the fund manager is doing that. I actually had a client of mine, and he was managing some of the money on his own, and he told me that the fund manager retired. They brought in somebody new who then changed the entire objective of the fund and sold just about everything in there. And his numbers, the manager's numbers looking forward, look great. But for all those investors in the mutual fund, they end up getting caught short with that, particularly in a taxable account, having to pay for all the what used to be unrealized gains that became realized now. So be careful about understanding what the hidden costs are. The next thing you need to ask with regards to expectations is, what kinds of funds do they use? Do they use alternative funds? Alternatives are a category that is supposed to help, and I won't go into that conversation about whether it does or does not, but many of the financial planners use alternatives to try to balance or protect the downside with the portfolio. Whether or not they use individual stocks or bonds, whether they use mutual funds. That's a traditional, tried and true way for many of the advisors to do, because they've been around for so long. However, there's typically, depending upon the category, a higher cost of doing business with mutual funds than there are in the exchange traded funds space, the ETFs or iShares, where they do something similar to mutual funds, but at a lower cost. And you may have more control over your tax exposure in the ETFs than you do with the mutual funds as well. So as you go in, you need to make sure that you understand what kind of investments that they make, and whether or not that makes sense for you. Finally, the old cliche is, we really show our colors when times are not great. Well, right now, times are very uncertain, right? With this crisis that we're dealing with, the recession that we're in, the volatility of the market that we have. What do you expect from your advisor during these times? And you need to ask that question. When things aren't going great, and we just went through the longest bull market in history, and now we're not. It was okay for the advisor not to communicate with you because your portfolio was going straight up. But now that we're finding all this turmoil and volatility, how do they respond during times like this? So if you want to learn more about the planning process and how to avoid some of the big mistakes with regards to income and retirement, click on the link below to learn more about our process and our approach. So let me share with you the story that I told you I would tell you at the end. A brand new client, that's neither here nor there. She is recently widowed. He had worked for General Electric for many years, okay? And like many of those in the old Fortune 100 companies, much of their 401k was in the stock that did real well over a long period of time. GE just happened to be one of those. And because they were in the GE, they were familiar with it. They felt comfortable with it. They thought they were doing well with it. And would anything ever change, right? Well, when he retired several years ago, GE's stock was somewhere in the $60 range. He rolled his 401k over to Fidelity, and really, therefore, there was no interaction, really no expectations, because he was just leaving it there. Though when he passed, his widow now assumed there'd be some communications. And what she uncovered when she sent the statements to us, because she now wanted some active management, was the following. The GE stock, which used to be worth somewhere around $1.6 million, and that was many years ago, we'll say 10 years ago, 12 years ago, now was worth about $600,000. And her question to me was, because the stock had dropped from about a high of somewhere in the vicinity of 60, and now it's down to somewhere in the vicinity of 6 or 7, shouldn't they have called me? Is what she said. I said, that wasn't their role. That really wasn't the expectation at the time. And what made it worse for her was that not only is she relying upon that asset now that she just lost $1 million on, but she lost $1 million during a time that the market was experiencing its greatest bull market in history. Meaning if that portfolio had been diversified properly, she'd actually have made money, more than likely, no guarantees for any future performance, but she would have probably been making money while at the same time she was losing the $1 million. So that mistake of not understanding the expectations of what to expect from that financial planner, Fidelity, cost her probably more than $1 million in value at a tough time for her, both now financially and emotionally. So make sure that you understand, most importantly, what the expectation is, what the relationship is with your advisor. If you found this to be helpful, please tell a friend, subscribe to our channel, hit the notifications bell. Thank you very much for watching, and I really do hope you enjoy the retirement journey.